Hey everyone, welcome to this explainer. Today, we're going to unpack something absolutely massive, literally one of the largest emergency liquidity interventions in history. We're talking about the Emergency Credit Line Guarantee Scheme, or as you probably know it, the ECLGS. If you've ever wondered how the backbone of the Indian economy managed to survive an unprecedented storm, well, you are definitely in the right place.
All right, so here's our game plan. We'll quickly recap the initial cash flow crisis, dive into that staggering 5 lakh crore Lifeline, and trace how the scheme evolved from version 1.0 all the way to 4.0. Then, we'll break down the actual mechanics, look at the lasting impact, and finally figure out how to navigate MSME finance today.
Okay, let's kick things off with part 1, the pandemic cash flow crisis.
So let me ask you this. How did Indian businesses actually survive the brutal cash flow disruptions back in the 2020 lockdowns? I mean, picture it. It's May 2020. A nationwide lockdown is in full swing. Revenues for millions of MSMEs just stopped overnight. But of course, your operational liabilities, rent, salaries, paying for inventory, those definitely didn't stop. It was a severe, terrifying cash flow crisis that literally threatened to wipe out a massive chunk of the entire economy.
Right, so the government basically had to step in, and fast. They needed a massive stimulus aimed directly at reviving operations, and that's where the ECLGS comes in. Launched under the Atmanirbhar Bharat Abhiyan package on May 13, 2020, this was born out of pure, absolute necessity. The goal? Super simple, but monumental. Pump emergency liquidity into the system so businesses could restart, meet their liabilities, and most importantly, protect millions of jobs. Which brings us to part 2, the Rs 5 lakh crore Lifeline. Seriously, just take a second to count the zeros here. That is an absolutely jaw-dropping 5 lakh crore rupees. Now, it didn't start that big. It kicked off with an initial corpus of 3 lakh crore back in May 2020. But as the pandemic kept raging on, the government progressively expanded the fund. They threw in another 2 lakh crore in the 2021-22 budget and later added a specific 50,000 crore just for civil aviation. All of that built up to this massive 5 lakh crore financial firewall.
And the whole thing was built on 3 really solid pillars. First, you've got that massive 5 lakh crore outlay we just talked about. Then, the real magic ingredient, 100% credit guarantee. And finally, a strict interest rate cap of 9.25% for banks and financial institutions. When you put those 3 together, it created this irresistible framework that worked beautifully for both the lenders and the borrowers.
All right, moving on to Section 3, evolution from ECLGS 1.0 to 4.0. So this wasn't just a static set-it-and-forget-it policy. The government actually responded pretty rapidly to the subsequent waves of the pandemic, expanding the program step by step. In May 2020, we got ECLGS 1.0, which was the broad-based scheme. By November, seeing that some industries were hurting way more than others, they rolled out version 2.0. And then heading into 2021, we saw versions 3.0 and 4.0 drop. Each phase was dynamically tweaked to address the most urgent crises of that exact moment.
Let's break down exactly how those target sectors evolved. Version 1.0 was for your general MSMEs. But version 2.0, that brought in the 26 stress sectors identified by the Kamath Committee, targeting entities with larger outstanding credit up to 500 crore. Then, version 3.0 brought some much-needed relief to the heavily battered civil aviation and hospitality sectors. And honestly, version 4.0 in May 2021 was absolutely crucial. As a direct response to the horrific second wave, it provided a 100% guarantee for loans up to 2 crore specifically for hospitals and clinics to set up on-site oxygen plants. Plus, it dropped the interest gap down to just 7.5%. It was literally real-time, targeted policymaking in action.
Okay, Section 4, key mechanics and benefits. Let's look under the hood.
So by completely absorbing the credit risk, the government essentially empowered lenders to support stressed businesses without any hesitation. Put yourself in a bank's shoes in mid-2020. You are terrified of defaults, right? But then the National Credit Guarantee Trustee Company, the NCGTC, steps in and says, look, if this borrower defaults, we are going to pay you back 100% of the principal and the interest. Boom, risk drops to absolute zero. This brilliant little mechanic is exactly what got the money flowing out of the bank vaults and straight into the economy.
And for the borrower, it meant pure, frictionless relief. The application process was surprisingly simple. You didn't have to go hunting for new banks or jump through endless administrative hoops. You just applied directly through your existing lender, since they already had your credit history on file. Best of all, no collateral required. For an MSME that's already stretched to the breaking point, not having to pledge your house or your factory to get an emergency loan is a huge deal. Plus, there were zero additional guarantee fees, unlike with schemes like CGT-MSE, and those capped interest rates made sure businesses weren't being taken advantage of at their most vulnerable moment.
Next up, Section 5, the scheme's lasting impact. Just look at this incredible reach. By the time the scheme officially closed its doors to fresh sanctions on March 31, 2023, over 3.68 lakh crore rupees had been sanctioned. And the best part is that this money didn't just get funneled to a few giant megacorporations. It reached more than 1.4 crore borrowers. The vast majority of those were exactly the people who needed it most, the micro and small enterprises.
And the data backs it up. Independent studies, including those conducted by the Reserve Bank of India, found that accounts assisted by the ECLGS had significantly lower NPA or non-performing asset slippage compared to accounts that didn't use the scheme. So what's the translation there? It worked. It kept businesses alive, it kept folks employed, and it genuinely prevented a massive, catastrophic wave of bad loans from just crashing the entire banking sector.
Finally, Section 6, navigating MSME finance today. Because, well, the ECLGS era is officially over. Without those emergency 100% government guarantees automatically flinging the bank doors open, you really need expert guidance to secure funding today. And that's exactly where organizations like the MSME consultants come into play. They act as a trusted partner for institutional loan facilitation, basically helping businesses bridge that gap between what they financially need and the increasingly rigorous demands of modern lenders.
By leveraging their expert documentation support, you can seamlessly navigate the pretty complex web of current institutional finance options. They offer vital services like acting as a liaison with the bank and doing comprehensive documentation audits, all at really competitive pricing. But crucially, they also offer the Loan Ready app. Since the ECLGS window is closed, businesses have to pivot to active alternatives, right? Things like the CGT-MSE or Mudra loans. The Loan Ready app acts as your ultimate digital toolkit to explore these currently available schemes and instantly verify the latest status with the banks.
So, here's what I want to leave you with. The government threw us a historic lifeline when the economic waters were at their absolute roughest. But today, the training wheels are officially off. Capital is definitely still out there, but the standards are much, much higher. So ask yourself, take a really close look at your own operations. Is your documentation totally cleaned? Are your financials clear? Is your business truly loan ready? Thanks so much for joining me on this explainer, and I highly encourage you to dig into those current institutional finance options to make sure your business keeps thriving. See you next time.